In this video, I'm going to break down the hidden tax trap for families with $5 million in retirement assets. Millions of dollars in unnecessary taxes. A client comes to us wanting to start planning for their required minimum distributions, or RMDs, right as they're about to turn 73. By that point, the train has already left the station. We've had cases where we've been able to help clients save over $1 million in taxes, but only because they came to us years earlier. This isn't something you can fix at the last minute. It's a tax bomb that's quietly building in the background for decades. And once it goes off, you can't stop it. So today I'm going to show you exactly how this trap works, why it catches so many successful people by surprise, and how a little forward planning in the right window of time can make all the difference. Let's get into it. All right, so what is this RMD tax bomb? It all starts with the money you've been diligently saving in your pre-retirement tax accounts, your 401k and your IRAs. You got a tax deduction for contributing, and that money has been growing tax deferred for decades. The problem is the IRS won't let you keep it there forever. They want to get their piece of the pie. Starting at age 73, they force you to start taking money out, whether you need it or not. These are required minimum distributions. And for families that have done a great job saving, these RMDs can be huge. Once they start, you can't turn them off. It's like a snowball rolling downhill, gaining momentum each year, and people are always shocked at how big they get. The RMD doesn't happen in a vacuum. It stacks right on top of your Social Security, pension, and any other investment income. Suddenly you're pushed from a comfortable 12% or 22% tax bracket up to a 32% tax bracket or higher. Your Social Security becomes taxable and your Medicare premiums go up. When you run the numbers over a 20 or 30-year retirement, a couple in this situation can easily pay over $2 million in taxes. It's a massive and largely avoidable tax bill with the right plan. Seeing numbers like that can be a little jarring. I get it. The good news, this is a solvable and preventable problem. It just requires shifting your mindset from reacting to your tax bill each year to proactively planning for your taxes over the next few decades. If seeing this RMD freight train heading your way makes you want to have a conversation about your specific numbers, there's a link in the description, or you can book a time to chat with us. So how do we actually solve this? Let's talk about the golden window. So if waiting till 73 is too late, when is the right time to start planning for this? It's in what I call the golden window. For many people, this is the period between 65 and when you're required to start taking distributions at 73. This window is so powerful because it's often the lowest income period of your adult life. You've stopped working, so your salary's gone. You haven't started Social Security yet, and the RMDs haven't kicked in. This creates a temporary vacuum in your taxable income, giving you a unique opportunity to take control of your future tax bill by strategically converting money from pre-tax accounts into a Roth IRA. During your career, your income is high. Then you retire and you enter this golden window. Then at 73, your income starts to spike again, and it increases every year and doesn't stop. Every dollar you convert is a dollar the IRS can never force you to take out. It shrinks the base that your RMDs are calculated off of, and it creates a bucket that's 100% tax-free for the rest of your life. The other thing this does is it decreases the tax drag on your portfolio because you're spending down the assets that are in the least tax-efficient types of account, and you're increasing the assets in your most tax-efficient account. So by doing this, you're going to get better returns because you're reducing tax drag. Tax drag is when you have to pay taxes on interest, dividends, and capital gains. When money's in your IRA and your Roth IRA, it grows tax deferred and tax free, so there's zero tax drag. When money's in a non-qualified account, there is tax drag because you have to pay taxes on the interest, dividends, and capital gains. Now, you can't have a smart Roth conversion strategy without also having a smart Social Security claiming strategy. There's one more critical piece that most people miss: where you're taking your money from. When you delay Social Security till age 70, you have less income coming in, which gives you more room to do Roth conversions. That's the easy part. But here's what most people get wrong. If you're pulling money from your IRAs to live on while you're doing Roth conversions, you're actually limiting how much you can convert. That's because pulling from your IRA creates ordinary income, which fills up your tax brackets faster. In an ideal world, you're pulling from your non-qualified taxable investments while you're doing Roth conversions. That way you can do much larger conversions without pushing yourself into higher tax brackets. It all has to work together, and your RMDs. When you combine all of those in a forward-looking, proactive manner, it can save you 7 figures in taxes. Let's look at some scenarios. Scenario 1, you pull $50,000 from your traditional IRA and do a $30,000 Roth conversion. All $50,000 you took out of your IRA is taxable, as well as a $30,000 Roth conversion for $80,000 of ordinary income. When you pull from your IRA, it counts as ordinary income, and this leaves less room for Roth conversions. Scenario 2, if you pull $50,000 from your non-qualified account, all $50,000 is not going to be taxable. There's going to be some capital gain, some return of basis. That will allow you to do a much larger Roth conversion with the same tax impact. By pulling from your taxable account, you preserve your lower income, allowing you to do much larger Roth conversions. We have a comprehensive integrated strategy for this. Number 1, delay Social Security till 70. 2, identify where your money is: IRAs, pensions, non-qualified accounts. 3, pull living expenses from your non-qualified taxable accounts first. Number 4, use that additional room for strategic Roth conversions. 5, you coordinate this to minimize RMDs and reduce your lifetime tax. This is how you move from being a victim of the RMD tax bomb to taking control of your financial future. It's not about one decision. It's about coordinating your entire distribution strategy: Social Security, Roth conversions, RMDs, and one of the keys is getting started early.